Hello, YouTube. I was wrong about the move that could happen overnight, as I am sure many people in the comment section are going to tell me today, but I have no problem admitting I'm wrong. What can you do? You can learn from my mistakes. And I think that this word is something you almost never hear on YouTube. People try to always pretend they're right. So in a little bit, we're going to go through exactly what that is. But first, we're going to talk about the fail, which is also in the title of the video. The fail is that I was right about its closing below the 50 DMA for 2 days. So what does that mean? I think we're entering the danger zone, but I was 100% wrong about the reaction today. I thought that if these numbers came in just at 3.6 and it's 0.3, I thought that this would actually cause a big sour reaction. I was wrong. CPI went up by 3x. CPI in a year over year went up by 0.5%. The market did not seem to care. So what does that mean? It tells us that if bad news can take us down, that is excellent. Why? Because what could good news do? Well, good news could take us a lot higher. Like what? Like a Fed pivot. So I think that's what the market's pricing in right now. It's like, okay, I'm not sure the Fed's going to move. We'll look at these numbers a little bit later. But as of right now, for September 20th, there is a 97% chance the Fed is not going to move. We can look out all the way to June to see where that first cut is actually priced in. And we're going to go through and tell you exactly what I was wrong about today. But just before we do that, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. And I will thank you ahead of time because you guys have just been such a great community and such a big support. All right. So not only was I wrong, but Michael Burry was wrong. Investors would have made more money by buying the S&P 500 instead of actually following big short investor Michael Burry, tweeting warnings. What does that mean? Well, Michael Burry's predicted like 8 of the last 2 recessions. What does that mean? Man, this guy's wrong a lot. But when he's right, he is really right. And that's a lesson for today. It's okay to be wrong. It's not okay to stay wrong. And what I was really wrong about was a prediction. That's one thing. It's a prediction on one single day. But on the weekly chart here, nothing's really changed. We got 4 weekly higher lows. We have no weekly higher highs, which means that we have a really tight consolidation zone here. We're either going to get an explosive move higher or an explosive move lower. And I'll explain the reason why. It's like a coil. As we have an inside bar, we're getting a really tight movement on price. And look at the volume. We're finding consolidation, which means everyone kind of agrees this is the current price. This is good. This is fair. This is what we should be priced at. When new data comes in, something's going to move the market, and it's likely going to give us a big move. I'm talking big move up or a big move down. All right, so now let's go through the news for today and see exactly what it is telling us, and then we'll go forward. Amazon, Alphabet, Microsoft, Meta probed by lawmakers on use of AI ghost staff. It's interesting to have a picture of Elon Musk there when they're talking about everything other than Elon. So this is just interesting because when we look to the heat map for the day, man, these stocks didn't do so bad. And I think part of it is what we talked about yesterday, where a lot of these fund managers are overweight. Microsoft, Google, NVIDIA, Amazon, well, these stocks appear to be doing just fine. The king, or Apple, is down. NVIDIA is up. But there's a lot of nothing happening. If we look at a 4-hour chart as well, or a 4-hour heat map, most of the losses happen at the open, which means most candles are going to look pretty boring, or they're going to look like dojis in the afternoon. This is also really interesting because I noted that we actually went all the way to 54, but now we're now all the way back down to 50, which means we're exactly where we closed yesterday. So when I look at the price, there is consolidation. I look at the volume, there's consolidation. I look at sentiment, there is consolidation. We can look at the CFTC net short positioning. There's also what? Consolidation. Let me see if I can find that. CFTC, investing.com. Let me just see if I can find this really fast. CFTC net. Here we go. I think I got it. I reset all my bookmarks, so I'm a little bit messed up here recently. All right, well, consolidation. So cover, 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 and flat. So positioning is even. We note that the sentiment is even. The price is even. And then we look out to the Fed. We'll look at this tool for a couple of minutes here. Then we'll look at some charts. We can look here too. All we're looking for is 525 to 550. That's the current rate. That's the current rate of interest for the Fed. So if we look out to the next month, all right, 525, 60% chance the Fed does not move in November. There is a 56% chance they do not move in December. There is a 54% chance they do not move in January. There is a 48% chance they do not move in March, which means we're pricing out those cuts. And as we're pricing out those cuts, this really matters because we're going to look at the Fed funds rate in a moment to compare to 2007 and 2008. All right, next one. In June of 2024, our first expected cut of what? 25 basis points. So now let's look forward here. All right, so now we're roughly like 31, 30. So maybe we get 2 cuts by July. It's basically even though. Or by this time next year, where are we going to be? Man, okay, so this time next year, we're going to have basically 2 cuts. Why? Well, right now we're at 5.25, and 12 months from now, we're going to be here at 4.75. So what does that mean? If you notice what we talked about before, where we have a rapid acceleration in interest rates like we did in 2004, 2005, all the way to 2006. And then look, July of 2006 to July of 2007, interest rates stay exactly where they are, 5.26. And then just like clockwork, in August, we get our first cut, and then the recession comes. So what we talked about is that most declines in a bear market actually happen after the pivot. And let me see if I can bring that image up really fast here, because I think this is a really important one for us to be looking at here. So open image in new tab. There we go. So if we have a look at this image here, what it tells us is that most declines actually happen after the Fed pivot. So if it's currently 2007, man, we can party, we can go higher, we can party like it's 1999 or 2007, and we can go up, 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 up. For how long? Maybe another year. Right, that's right. Maybe another year, maybe less, maybe more. I'm not sure. But right now we're looking for basically nothing to happen until June, which would be almost 9 months. The Fed hasn't really moved recently, so we can note that it would basically be us hovering here at the same rate of about 5.3 like we did before. If we stay flat for about a year, that could be where the bears are ultimately right, but they got to go through a lot of pain before they get paid. And then the great part here is the recession. So they cut, there's a recession. 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 That's the same thing we're looking at here. This one just looks more scary because you see the negative numbers. Market goes down 36, 48, 27, 51, 58, and 35%. But it always happens after they pivot. And why would that be? It would be because the Fed pivots after something breaks. So, sorry, after something's broken. Right now, they're breaking some stuff. They're like a bull in a china shop. Things are breaking. Like we look over here to IET or KRE, which is the regional banks, and they're getting a drill today, right? They're down. They're not really recovering. Here's where SVB happened. Man, we haven't really gone anywhere. Went a little bit lower, a little bit higher, but basically right back to where we started. There's not a lot of progress being made by these regional banks. So that's likely what's going to be the issue. We talked about that on the weekend too, where there's a huge wall, $17 trillion by the U.S. government that's going to come maturing in the next 12 months. And then also trillions of corporate debt, which are going to come due. So if we think about that and something's going to cause something to break, well, the Fed goes right back down to zero pretty fast, right? We look here from about August all the way down to about right to December, less than 6 months, they go from 5 all the way down to 0. So as fast as they raised it, and look where they started. They started at 1%, they went to 5, and then they put in a lower low. Then we went to zero interest rate policy, or ZIRP. So we started here, we put in a lower high, and now we put in a lower low. I don't know what's going to happen. All I know is right now, people don't care about what's going to happen from a year from now. All they care about is what's going to happen tomorrow. So what's going to happen tomorrow? Well, there's no more economic data. Let's have a look at that calendar one more time, because maybe I'm wrong. I know that CPI was the most important number for me. There might be one more data point this week, though. We got PPI, initial jobless claims. I don't know that this is going to move the market. I don't think so. But hey, you guys are going to tell me in the comments, Justin, you were wrong today. So what else are you wrong about? Well, I might be wrong about this. I don't know. I have no idea. But we saw the Bank of Canada pause their interest rates last week. The ECB is currently expected to also pause. And then I don't know what these numbers are going to do. I have no idea. So I think right now, if bad news cannot take us down, let's be pretty receptive to what good news could do. What could good news be? Man, maybe the Fed does what the Bank of Canada already did and what the ECB is planned to do, which is what? A whole bunch of nothing. Hold interest rates flat going into an election year, which means what? It's time to go back up. And this template that I shared going all the way back to, I believe, July, it's now a couple of months later, it's been playing out. And even if we only go to here, it's still technically an inside bar. So if we go here to SPX, it's still an inside bar. We can hold the low. We don't have to go down to the low. It's just what I want. What I want and what I get are two different things. So I want to get a discount. I want to buy on the low. But if we don't form that monthly higher high, there's not the pattern completing, which means we're not going to be going to higher highs. We're just consolidating. So right now we got high, lower high, lower high, low, lower low, higher low, inside bar. So we have consolidation on the monthly. We have consolidation on the weekly, where man, if we were going to get the cut, like it should have already been happening. So this is really, really, really weird. What I also want to note is just that if we look here to the dollar is up by, let's look on the day, the dollar is up by about 0.2% today. S&P is up, QQQ is up. So what's going on here? Well, let's look at the weekly chart. Right now, the dollar is down by about 0.28% on the week, and the S&P is up by about 0.22, which means they did smooth out, but we have to look at the weekly chart, not the daily, to actually see that. So I think that the dollar is moving higher because inflation's up. It's getting a little bit ready for the Fed. And I can look at one more piece of evidence to see that. We got yet another tap at 430. So here we have our 436. Here we got 435. So that is a 1 basis point or 0.01% lower high. But man, it's so close to that W. I'm getting a little bit worried. It could be a fail where we ultimately see that the Fed's going to pause. We don't go higher. If the Fed hikes, though, this is probably going to get a breakout, and it's probably going to lead to the crash. We saw one in March. We saw one in 2018, and we're probably going to see that same thing now. So we're looking at those same periods here, like March of 2022, right? We see that same W happen on the 10-year note, and then it goes down. We've been talking about the relationship between tech and the relationship between the 10-year note as well, and something's got to give. It's either that the 10-year note's going to tank or that tech stocks are going to tank. So we spent a lot of time looking through a lot of different things this week. I want to provide you one more piece of data, which might add a little bit of light to the current situation we're in. And before that, NVIDIA is back above the 50 DMA. So, right, it's still the king. It's still strong. Move over, Apple. We got a new king. I want to look here to two different charts. I want to look here to this one, which tells us that this is the S&P 500 above the 50 DMA. So what does that mean? At 34, 1 in 3 stocks in the S&P are currently over their short-term price, which means 2 out of 3 stocks are trending down. That's not good. That means we're top heavy. It's big tech, which is why I'm spending so much time focusing on big tech. The short term is actually worse than the longer term, though. So this chart here looks at the 200-day moving average, and it's better, but it's about half. So half of the stocks are currently below their 50 DMA, 200 DMA, or the long-term price, and about half are above. So the longer term is definitely stronger than the shorter term. But if the market's going to make a leg higher or make that higher high over 460 so far this year, this has to move. It has to move higher. We can't see just a few names dragging the market up. So if we want to win for the bulls, we have to see them come in and show up and drive the chart higher. It's that simple. So thank you for tuning in and thank you for watching. If you want to join us for a weekend deep dive, that's now queued up here on the left-hand side. Thank you so much for your support. And I apologize I was wrong. I will see you guys tomorrow. Thank you again.